I would start by explaining what actually happens when you pay anything to the government. With online banking, you can see it. You look at your bank account, it might have $5,000 in it, and you send $1,000 to the government, and you watch your account online very closely, and it goes from 5,000 to 4,000. So what actually happened? All that happened was the government changed your number from a 5 to a 4. Nothing goes anywhere. Nothing comes from anywhere. They just changed that number. Now, if you receive money from the government, like when I get my Social Security check, and if I had $4,000 in my account, the $4,000 changes to $7,000. I get my $3,000 payment. And all the government does is change the 4 into a 7. They don't have money. They don't not have money. They're just the scorekeeper, changing numbers up or down. Nothing's constrained by the number. It's just constrained by their desire to change it up or down. The Social Security Trust Fund is just a record keeping of what numbers they changed up and what numbers they changed down.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, which I've linked to in the show notes, along with some other things that relate to this particular episode. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT Podcast. Support starts at $1 a month or £1 a month or whatever the equivalent is wherever you live. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. A big thank you to all of our supporters so far, and thanks as ever for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT Podcast. I'm Christian Riley.
And I'm Patricia Pino.
And we're delighted and honoured to be joined today by MMT founder Warren Mosler. Thanks for joining us today, Warren.
Good to be here again.
So we've had lots of juicy questions come in from our patrons to ask you, Warren, and I'm going to read the first one. And I chose this one to start with because it's about the fundamental MMT money story. So here we go. This is from Mark Cano. He writes, reading Kelton's Can Taxes and Bonds Finance Government Spending helped me understand why our tax dollars aren't funding the government. Since there are funds that exist specifically for Social Security and Medicare, though, is there a better angle or more simple way of engaging with folks about how their tax dollars aren't funding these programs, even though they clearly see the FICA deductions from their paychecks?
So that would be chapter 4 in my 7 DIF book, free online, non-technical. Take them 5 minutes to read it. And I would start by explaining what actually happens when you pay anything to the government, a tax or buy anything. And with online banking, you can see it. You look at your bank account, it might have $5,000 in it, and you send $1,000 to the government, and you watch your account online very closely, and it goes from 5,000 to 4,000. So what actually happened? All that happened was the government changed your number from a 5 to a 4. Nothing goes anywhere. Nothing comes from anywhere. They just changed that number. Now, if you receive money from the government, like when I get my Social Security check, and if I had $4,000 in my account, what happens on the first of the month or so is that the $4,000 changes to $7,000. I get my $3,000 payment. And all the government does is change the 4 into a 7. It's just scorekeeping. So it's the same if you go to a football game and your team kicks a field goal in America, you get 3 points and your score goes from 7 to 10. It's, where did the stadium get those points from? It's just not an applicable question. So any payments made to the government, all they do is change the number in your account down, and any money they give you, is the way they say it, they just change your number up. So they don't have money, they don't not have money, they're just the scorekeeper, changing numbers up or down, and you can call it anything you want. You can call it Social Security, you can call it this, you can call it that. They're just changing numbers up and down. Nothing's constrained by the number, it's just constrained by their desire to change it up or down. The Social Security Trust Fund is just a record keeping of what numbers they changed up and what numbers they changed down. It doesn't cause anything, it's just residual record keeping. So let me leave it at that, and please read chapter 4.
Okay, so the second question is from Peter Cunningham. I hope I pronounced that right. He asks, how do I best convince an MMT skeptic that in the UK, taxation drives the need for the pound? They seem to think that sterling has intrinsic value in which the user must have confidence. Does that allude to the money story, Warren?
Yes, give them the money story, but tell them, look, if that was true, don't you think the pound would have gone to zero a long time ago? Nobody has any confidence in the pound, and yet it remains. And even during a major crisis, it may go down a few percent, but it remains, and it still drives all the production and all the consumption in the country. And you can use the money story. You can use other examples. It's a conceptual understanding, and if it's too hard for somebody, I guess it's too hard for them. I'm not sure where you go from there.
Okay, third question. This is from John Ibbotson. If taxes aren't needed to fund government spending, how can the left argue for taxing the high-paid and wealthy? Why wouldn't the right argue for tax cuts?
Well, they would, and they do, and they're successful, and they don't have the inflationary consequences, but they do exacerbate the income distribution issues. And the left should be arguing them on exactly that, using that criteria, that the reason we want to tax away money is because we don't want them to have it, not because we need it. They just need to be honest about that. We don't want them to have the power and influence that they have due to having money. That's the intellectually correct argument. And, either you believe in a, informed electorate making decisions or you don't. So give them the accurate information and let them decide.
Okay, so the next one is Paul Dandurand, and he asks a question about government selling bonds to match the spending or deficit. When the government spends, the government creates money. If I understand this correctly, in order to keep central bank interest rates stable, the government sells government bonds to mop up the liquidity that is created from government spending. Banks can then buy those government bonds to gain interest earnings. Is it correct that this is the main reason why the government establishes bonds in equal amounts to the spending? Or is it in equal amounts to the deficit, the difference between spending and taxing? Since this is a cornerstone of the bond part of the national debt, can you explain if this is still necessary today? If the government stops issuing bonds, then are there other means to stabilize interest rates for the banks?
Okay, so that's in soft currency economics. That's what started the whole thing. And that was written 30 years ago. It's fairly short, and it's also covered in the 7 DIF book, which is less technical. And, parts of that are correct, but the basic understanding is that the government spending adds money to people's bank accounts, as I spoke of before. They just change the numbers higher. And then when someone pays taxes, the number gets changed to a lower number. And that lower number that remains in the account represents the deficit spending, the difference between spending and taxing. Spending makes the number higher. Taxing makes it lower. Then you have a number left over. And that's the public debt. And rather than leave it in non-interest-bearing accounts that used to be non-interest-bearing, the government offered government bonds, securities, bonds, bills, and notes that were nothing more than alternative accounts at the central bank that paid interest. Well, nowadays, what they do is they just pay interest on the original checking accounts. They call it interest on reserves. And that's a perfect substitute for offering separate accounts. So they can now support interest rates simply by paying interest on these reserve accounts, which they didn't used to pay interest on before. And now that will support interest rates.
Okay, this is number 5 from Peter Janowski. How is the job guarantee anti-inflationary?
So what we do now for price stability is we use unemployment as what you call a buffer stock. So there's this army of unemployed out there. They are the thing that keeps downward pressure on wages because people working are afraid to lose their job and become unemployed. And businesses can hire people who are unemployed, who aren't working and getting any money, presumably at a lower price than hiring somebody who already is working at a higher wage where you'd have to pay them extra. So by having a reserve of unemployed always there, desperately looking for work, that's what we do now as inflation control. All right. So what we're saying is alternatively, what we can do is use people who are already working as inflation control rather than unemployed. And all we have to show is that that's a better inflation control than what we already have to make it absolutely compelling. We don't have to show that it's a perfect inflation control and controls inflation and everything, just that it's better than what we have now. So what we say is that an employed buffer stock, which is the job guarantee, the transition job, an employed buffer stock is a superior price anchor to an unemployed buffer stock. And why is that? And that is because business prefers to hire people already working. They don't like to hire unemployed for a variety of reasons. They might be on drugs. They might get fights. They could have all kinds of poor work habits. They won't show up on time. They don't know. It's a high risk hiring somebody who hasn't been at work for a while. And so they'd rather pay a little extra and hire people already working. Well, that reduces the value of unemployed as inflation control. We've seen inflation go up even with high levels of unemployment because they don't act as a buffer on wages the way we'd like them to, because business really doesn't want to hire them to begin with. So by using a employed buffer stock, offering anybody a job who wants a job at the buffer stock wage, which will, as a point of logic, be the lowest wage in the economy, right? And let's say it's 10 pounds an hour, just for a number. Okay, now we have people already working. So now when a business goes to hire, they've got people who already have been coming into work, to jobs every day. They have a supervisor. They can ask them if they get along with people, if they're clean, if they recommend them or whatnot. And they will be more likely to hire a worker in the transition job program than they would be to hire somebody who's unemployed. And so that makes the transition job a superior price anchor to unemployment. Again, not that it's perfect, but it's far better than what we have. And so there's absolutely no reason to not do it immediately and massively improve output, employment, standard of living, everything. The only reason you might not do it is because you didn't understand government finance, as we just explained before, and you might be worried that it might cause the deficit to go higher, even though it's a better inflation prevention than having an unemployed buffer stock.
Isn't it the case that you and Bill have projected that you would need a much smaller NIBUR than you would a NIRU, if you know what I mean?
Yes, because an employed buffer stock is more effective at transitioning people into the private sector, which is the whole point, then it doesn't need to be as large. And so you can have a lower level of transition job employment than you would unemployment and still have a better price anchor. Yeah, absolutely. And there's a lot to read on this. On my website, I have a paper called Full Employment Price Stability, fairly short, and it goes into some of these details.
So the next question is from Nick Stewart, and it says, my wife is a nurse and would rather she was better paid. The state is the price setter. When it pays higher prices, it revises the value of the currency down, reducing purchasing power, i.e. it's inflationary. Can nurses get a pay rise without creating inflation? I've always been concerned that the MMT lens could be used to argue against fair wages.
Yeah, so the answer is, right now, for example, in the UK, there's a lot of unemployment. So by paying more to the nurses, it would add to aggregate demand, and you'd have the private sector more likely to hire, although it would be better if they weren't unemployed. It would be better if they were in a transition job. But still, the way the program works now is that the unemployment is the evidence that the public debt is too small, that the deficit is too small, that the government has not spent enough to cover the need to pay taxes and the desire to save. So there are different ways to get to that level, and one of them would be to pay nurses more. Now that would give nurses a improved what's called real terms of trade. Their real wage would go higher than somebody that didn't just get an increase. And what you have to look at is then what real wages are, and on that scale, are nurses on a relative value compensated where they should be relative to doctors, relative to workers in education, teachers and things like that. And if they're all kind of on a par as to where they should be, that's one thing. If one group has fallen behind and needs to catch up, that's another thing. And I think the situation in the UK is that nurses have a long way to go to just catch up. And any minimal ripple that would have on distributional issues would be trivial compared to their need to catch up, particularly compared with their usefulness and any kind of social equity in the society.
This is from John Ibbotson. Millions of workers in the UK public sector, including the National Health Service, are striking for large percentage pay increases. If paid in full, the wage claims could add 10 billion per year to government spending. The health minister says it's not affordable. What does MMT say are the options, implications, and consequences?
Well, number one, the checks won't bounce. Number two, it won't cause interest rates to go up. Those are independent decisions. Look, if the UK cuts interest rates to zero, how much does that cut fiscal spending? like a lot, far more than that 10 billion. You'd have a lot of room to increase spending just to get it back to where it was before. Number one. Number two, spending at the moment is deficient based on the unemployment rate in the UK. And so there's plenty of room to do that right now in the UK economy. So what you look at is the government spending enough to cover the need to pay taxes and the desire to save? And the evidence they're not is unemployment. Why? Because any additional money the government might spend on unemployment, any additional deficit spending, there's only one of two things that can happen when those funds are spent. Either they can be used to pay taxes, that is, when the government credits an account, they can either pay taxes and that account is debited, or they're not used to pay taxes and they wind up as savings in somebody's account. And the only reason the economy would be throwing people out there, or not throwing, but putting people forth looking for work at the macro level is either to pay taxes or net save. So unemployment is the evidence that spending is not enough to cover those two needs that are created by the tax liability. Okay, and again, that's outlined in my 7 DIF book, 7 Deadly Innocent Frauds, and in Soft Currency Economics. So I'd highly recommend reading the 7 Deadly Innocent Frauds. I think that'll become painfully obvious after 15 minutes.
I have a follow-up question. You mentioned that the UK has a lot of unemployment and therefore inflation isn't a concern, but we're always told that the UK has very low unemployment and that we're record low unemployment and our unemployment rate is like 3.6, if I'm not mistaken, at the moment. So can you explain a little bit more of why what you're saying is so different from what the main narrative about UK unemployment is?
They have this narrative that if you hire people down to a lower level than that, let's say 2%, you will cause inflation. That's called the Phillips curve, and it's just shown not to be true. You see much lower rates than that in other countries. Also, I think you have another measurement that includes like part-time workers and people marginally attached and that type of thing. And people who, in the labor force that would take jobs if they were offered, but they don't strictly qualify as unemployed because they haven't been actively looking for work or something. And generally that number is about double that particular rate. The second thing is they say inflation, but what they mean is the cost of living, right? The CPI. And that's a very different thing. And inflation is a continuous increase in prices. And what they're talking about, or what they're afraid of, worst case, might be a one-time increase in some of the components of the consumer price index and not a continuous increase, over time that's going to have some kind of presumed negative effects. Now, the other thing is there are no negative effects to the economy because of high inflation. No economist has ever been able to detect any negative effects. There are negative political effects because people don't like it. What they're talking about, behind the rhetoric is if they do this and the consumer price index goes up, they might lose the next election. There's no way it's going to make the economy worse. You look at Argentina with 90% inflation, and they're outperforming the UK and other countries in terms of, GDP growth and, the stock market's going up and all kinds of things. And so the way to say it is if you look at real standards of living and what's happening in the UK, the idea that because unemployment's only 3.5, which is millions of people, that having those people working productively is somehow going to have an adverse effect on the well-being of the United Kingdom is complete nonsense. There's no basis, to that statement.
This is from Danny Roberts. I'm reading John Kenneth Galbraith's 1954 book, American Capitalism, in which he introduces the concept of countervailing power as the operative check on market power in the absence of classical conditions of competition. A union wields countervailing power against a large employer, for example. In the presence of a job guarantee, what are the primary checks on market power? Is one or both of classical competition or countervailing power strengthened as a check on exercise of market power? Okay,
so what's happened is, of course, labor's market power, if you want to call it that, has vanished, for the most part since the 1980s. And you can see it in the share of wages versus profits. And that just went flat due to international competition and, all kinds of forces coming in. But what's at the root of it is that the labor market is not a fair game. It's simple mainstream game theory that they conveniently overlook. And the reason is that, people have to work to eat, while business only hires if it feels like it's a good return on an investment. That's a huge disparity of power. So look, even if you're the last guy unemployed looking for a job and you can't find one, and then somebody offers you one, your choices are take the job or don't eat. All right. And so you don't have any market power, even if you're the last guy. So the idea that as the unemployment rate gets smaller, the market power of the remaining unemployed goes out, that's complete nonsense. And so what that means is that real wages will stagnate at somewhere near subsistence levels unless there's some support for labor. And so if you want a society where real wages are near subsistence levels all the time, then you just leave it alone. And that's what we have. And if you want a society where the share of wages, you want it to be higher than it is, higher than subsistence levels, and the real standard of living of working people is above subsistence levels, maybe at the expense of the ultra rich having a lower standard of living. They can't have a super yacht that's quite as large or something like that. If you want the distribution of resources of real consumption to be skewed other than a bare minimum to the people who work and produce for a living, then there has to be some kind of institutional structure to achieve that. Otherwise, the institutional structure that we have forces real wages down to stagnate down at subsistence levels. And that's just a simple point of market logic based on elementary game theory that there is no dispute for that when confronted. So when you confront any mainstream economist with that, they'll agree. But nobody ever confronts them with that. They all go with all kinds of other discussions. That one they have, no way to disagree with. And so because we have a government that employs a coercive taxation to create forced sellers in the private sector to do things to get the government's funds so that it can pay its taxes, and that's the basis of how we transfer resources from private to public domain, then the institutional structure that starts with that, determines the distribution of real consumption. And by leaving it as it is now, that structure is determining that real wages will stagnate. It can just as easily be adjusted for real wages to be a much higher percentage of GDP. And that's a political choice. Those two choices are political. They're not something that naturally happens in market economies that don't have coercive taxation, because there is no such thing. All of the economies today that have a government have coercive taxations. That's a monopoly. So there's a big fat monopoly right in the middle at the center of all economies. And the idea of market forces doing this or that is obviated by monopoly. So those are the facts we face, and we take it from there.
Yeah. So the next question is by John Ibbotson. He asks, UK politicians have an endless debate about public investment in rail transport infrastructure. The sum seems small, 40 billion over 15 years or so, compared to COVID support and waste, hundreds of billions. The same goes for public investment in energy infrastructure and in hospitals. Is there an MMT perspective that can get the nation what it needs quickly? Is there any limit to government spending? In brackets, right now, GDP is approximately 2.5 trillion and annual government spending is approximately 1.1 trillion. Government debt is at 100% of GDP.
Yeah, well, the finances aren't the issue. The issue is for rail, whether there's enough steel, there's enough rail cars, or enough people, that you'd rather have driving trains and servicing trains than you would doing something else. So if you had a war and you needed everybody in the military, you'd say, I don't want to pull people off the front lines to build new rail cars. But, maybe you would if you needed them to service the military, I suppose. But those are the types of questions that you ask is, how do I want the real resources of the country allocated? Now, personally, for me, it's not an MMT thing. I think buses are a more efficient allocation of real resources than trains. At least in the United States, they're a whole lot less expensive because in real terms, they consume less energy per rider and they are less expensive to build and operate and everything else. So we already have the rails, and there are already some limited areas where we ride buses on rails by, paving the areas on both sides of the rail so a bus can ride on it. And then you get no traffic bus transportation at a fraction of the price of rail. So a train might cost $100 to go from New York to Washington. A bus might cost $25 or something like that, reflecting, those kinds of resources. And the bus on the rails, of course, would go a lot faster and be more efficient than the bus on the road. So it would be even lower cost to do it. I'm not trying to argue for that, but I'm just saying that those are the kinds of arguments that are public purpose is about. Which resources do we want in the private sector? Which resources do we want in the public sector? And then once you've decided that, then the monetary system can accommodate and get us from here to there.
This is from Colin. Can Warren please talk a little bit about how rate hikes are inflationary via the interest income channel, yet rate hikes also appear to be correlated with the onset of recessions? Not sure what to make of this push me, pull you effect.
So number one, I haven't seen a research paper out of any central bank in at least 20 years in support, of the idea that rate hikes slow down the economy and bring down inflation. The last one I saw was, Bank of England 25 years ago or something, saying that a 1% increase in rates would bring inflation down by 0.1% with a 2 to 4 year lag. Okay. There hasn't even been anything like that in 20 years. Now, they're all pursuing these policies, presumably based on science. You'd think they'd have some research papers showing that this stuff has some basis in their research when they do the econometrics for the real economy, but they don't. It isn't there. And if anything, there have been papers around the edges from the Fed, some of the regional Feds coming out showing what I've been saying. So number one, there is no research behind any central bank assertion that rate hikes will slow the economy down and bring down inflation. Now, anecdotally, you can say that recessions have followed rate hikes, but they've always followed something. They've also all followed a jump in oil prices, like in 2008 up to $155 a barrel. Of course, certainly in 1979, oil went from $3 to $40 and those types of things. So, and you've seen budget deficits in real terms collapse in front of all the recessions. And so you've seen fiscal collapses in front of every recession. And so, things happen in front of recessions. And when I look at the rate hikes, they were delayed the onset of recession until one of these other forces came along and drove us into recession. That's how I read the data. So number one, I don't read the data the way your questioner does. Now, as far as interest expense goes, every mainstream economist forever, up until 2 years ago, has been screaming at us, watch out for budget deficits. I mean, I had a discussion with Paul Krugman when he was having that discussion with Stephanie Kelton about why it's not a good idea to use deficit spending to sustain a job guarantee. He said, look, if the deficit gets too high, that means we're paying interest on all of that debt, which is true. And if it's too high, that means if the Fed wants to fight inflation, it can't do it by raising rates because the interest expense will cause inflation rather than slow it down. And that was his argument as to why we can't use massive deficit spending to sustain full employment. And I agreed with him. That's absolutely correct. And that's the reason I support a permanent 0% rate, so we can use deficit spending. We can deficit spend to support full employment, maximize output and real standards of living, and not raise rates to fight inflation. Because why would we want to do, there are other things to do. And that I agree that you can't use rates to fight inflation. Now, back then, the debt to GDP was only 55 or 60% of GDP. And all the other economists were saying the same thing, that you got to be careful. And I watched in 2008 to see what the data was telling me. I talked about it then. I said, I don't think these rate cuts are going to help the economy in any noticeable way because they're cutting interest income to the economy by cutting rates. And Bernanke's rate cuts from 5 or 5.5 to 0 cut maybe $400 billion a year of government interest expense. And I was saying, that's works against growth. It's a cut of the deficit by those large amounts. And if you looked in Europe, I was at Rimini in 2012 when Mario Draghi made the statement that we're going to do what it takes to prevent default, and rates were 7% in Italy. Their rates and on the way to infinity, they were all panicked. That's why Draghi said that. And they started coming down. And I said, yeah, rates are going to come down, and there's not going to be a default, and the government is going to be saving money on interest expense, but that means the private sector is going to get a lot less money on interest expense. Their debt to GDP was 125 at the time. And so the private sector in Italy is going to stagnate as rates come down because of those lack of interest income. It's taken away from them. And looking at the data over those 10 years or so, I think it played out that way, which is why the Fed doesn't have any reports anywhere showing how rate cuts help the economy, because they didn't. And they certainly didn't cause inflation or anything else. Nothing happened until after COVID. Inflation stayed very low. In Japan, 30 years of zero rates with no inflation. And so once, COVID hits, and they also prove that government checks don't bounce. They just add $2 trillion of deficit spending and no taxes, and it just goes through like water, and rates stay low, and none of these bad things happen. No solvency problem. The Fed did estimate that CPI went up by 0.5% a year because of the additional deficit spending. Okay. And then we got the large jump in the CPI when oil went from, 30 or 40 up to 120. And that pushed up the CPI. Fine. Now, I'm saying the question is about rate rate increases. And so the Fed response to that has been to increase rates. And as soon as I started doing that, I'm saying, look, debt to GDP is now 120%. It's doubled. So the effect of these rate increases or decreases, the income effect is double what it was historically over the last 30 years, because debt to GDP was always half that. And now we're back to like what it was in Italy in 2012, and it had a dramatic effect. So I'm saying that these rate increases are just going to be throwing gasoline on the fire. The extra deficit spending from this increasing interest rates, which ultimately on a $30 trillion public debt, which is 120% of GDP, is if you increase rates from 0 to 4, where they are now, 3 3/4, you've added over $1 trillion annually of interest expense. It's all deficit spending. You've increased the federal deficit by $1 trillion, paying interest, which is, basic income for people with money. It only goes to people who already have money in proportion to how much they have. There's nothing on the supply side. It doesn't add anything for sale. This is just, pure demand side with no supply side. That is going to support to some degree, maybe a large degree, output, employment, growth, and prices. And it's not going to slow things down. It's going to speed things up. And maybe we were on the fence when debt to GDP was 55 and 60. I don't think so. I think even at that high a level, we were, they had the interest rate thing backwards. I think Greenspan's rate hikes supported the economy, and I think the data shows that. But now at double that, it's got to be, gangbusters. And if you look, since the rate increases started, GDP was struggling around 0. And then second quarter went up to 2 something. And now the latest estimate out of Fed, the nowcast, and we're getting to the end of the quarter, is 3.4. And you look at all the personal income numbers, which are all supported by high rates. Households are net savers. They're just going through the roof. And the economy's strong. Yet everyone's forecasting that we're going to have a recession next year because the strong economy is going to cause the Fed to raise rates even more and so the recession is going to be that much worse. And I'm going, no, you're going to raise rates even more, but that's going to make the expansion that much stronger. Now, the markets can't foresee that yet because they've got it stuck in their head, that rate hikes cause recessions. And so here we are. And where does it end? Well, I was in Argentina in April talking to people, including the central bank. Inflation was 40%, rates were 35%. They were keeping a real rate of 5% to slow down inflation. And I made this exact same argument. You're spewing out all this peso interest, which over there, they don't even spend it or anything. It just goes to the foreign exchange market and they sell it for dollars and the currency goes down. And they get inflation through the import prices, which causes the government to raise rate. So inflation goes to 50, so the government raises rates to 55. And so they're paying more pesos into the foreign exchange markets because the savers there don't want pesos and they want dollars. So they just sell pesos and buy dollars. And inflation goes up to 60. So rates go to 65. So I was there in April when rates were about 40. Now they're about 85 and inflation's about 90. Like there's no end to this. They're causing this thing to happen. And we're started on that path. Does it go as far as Argentina? Probably not. We'll probably get something to knock us off the pedestal. Before then, maybe oil goes to 300 or something. But that's the path we're on right now.
Is it fair to say that the rate hikes aren't having the stimulative effect that we would kind of desire as, humans in an economy wanting a progressive distribution of wealth?
Yeah, this is the most, it's the most obscenely regressive policy possible. The worst dramatic iteration of trickle down ever invented.
The people who are getting the benefit of these rate hikes, the recipients of the interest income, their marginal propensity to consume is relatively low, basically.
Yeah, and not that that's a bad thing, but but what's happening is that they're getting enough interest income so that the money they do spend is supporting the economy, and that's a regressive trickle-down economy where now the rest of us are beggars to the people getting the interest income for jobs and scraps at the bottom of the pile. Look, the Fed is independent. We all want independent monetary policy, right? So they have independently decided to give over $1 trillion a year when they were giving nothing, but to give $1 trillion, it's not really nothing because they were paying a little on bonds, but to give another $1 trillion a year to people who already have money in proportion they already have in order to fight inflation. We've let our independent guys do that without Congress, without discussion with anybody else except their own internal discussions. And here we are. And that's what's supporting the U.S. economy right now. It's like wonderful, huh? I was in Christian said for lunch today down by the water. And we have something that I forecast or, mused about 40 or 50 years ago with my partners. And we have, tourists on cruise ships from Latin America having lunch, being serviced by American, the equivalent of what back then was, let's call them peasants, right? Just to make the point, working for, $8 an hour or something, $10 an hour at these restaurants, servicing tourists from South America. Now, back then, of course, it was the reverse. The Americans were down in South America getting serviced by people down there working for nothing. So we've come full circle now, and congratulations to us.
Great. Does that mean we're a developed country now?
The insanity, there's no end to it.
Well, I just wanted to clarify one thing to get it clear in my head. Earlier, you said that the means we have to control inflation right now is to move to manipulate unemployment effectively and to increase unemployment and decrease unemployment. But now you're saying that even the mechanism by which they attempt to do this doesn't actually do what they think is going to do. In the sense
right, it makes unemployment lower.
Right.
Unemployment's been coming down since they started raising rates. Employment's been going through the roof. The last headline was the Fed now is really in trouble because the job market's so strong, they're going to have to raise rates that much more. It's, I used to talk about the carpenter with this piece of wood. No matter how much I cut off, it's still too short. Or the hairdresser, no matter how much I cut off, it's still too short. That's what the central banks all over the world are doing now.
So the next question is by Kenny Sabares, and I kind of wish we had a visual medium to answer this question, but I'll ask it anyway. He says, hi, Warren. If I remember correctly, you often talk about how raising interest rates generally does not slow down business borrowing. Can you show us what data we can use to show this point? You often tweet graphs from Fred. Can you explain which ones we need to use to show this? Can you also show the different graphs to differentiate between business borrowing for business, buying homes and refinancing, and finally, government interest payments? I just want to make sure I am reading them correctly when showing them as evidence to others.
Yeah, just go to Fred and start with bank loans, and they'll give you a whole series of things, and you can just pick the ones you want. Total bank loans for real estate, bank loans for consumers. They'll have credit cards, total credit, all kinds of securitized credit. They'll have all that. Then they'll have federal government expenditures for interest, and they'll have receipts, and they'll have all kinds of things. And you just start looking these things up and you'll find them. Now, what they don't have that I've been able to find is because of all this, and I won't discuss it, but quantitative easing. So Fed owns the government securities, but they pay for them. They've created balances in accounts at the Federal Reserve, which are held by commercial banks on behalf of regular people who have money in their banks. And so they pay interest on those, and it's like $8 trillion. It's a lot. And those interest payments, I haven't been able to find on Fred where the interest on those payments is, but you'd want to look at the difference in those, how they've gone up since the rate hikes have started. So you'll get the government interest expense, but it's just the U.S. Treasury. It doesn't include the Federal Reserve. So go through it, look it all up, and just be careful that some of the things are very specific. Interest paid by the U.S. Treasury, not necessarily interest paid by the Federal Reserve.
This is from AJ Wales. If we could assume central banks around the world are not stupid and they know interest rate increases don't curb inflation, that's a big if, then why do they insist on raising rates? Are there any other outcomes than the potential for increased unemployment? Are there any potential benefits?
Okay, so let me say, all I can think of, this is all premised by all I can think of why they do this, is that they don't understand where the value of the currency comes from, which was an earlier question, just like one of your readers. And they believe it's all confidence. And if people lose confidence, like they saw what they thought happened in the UK rather than a technical thing in pension funds. But if people lose confidence, then, they turn into Zimbabwe or Venezuela or something like that. And so they have got to be very careful to maintain confidence because they don't understand tax liabilities are the source of value. And so they also know that people that are worried about inflation and in whatever form they define it, and the monetary system in general, and that people also believe that raising rates is the medicine to cure this problem, then to keep confidence, they have to raise rates, and they're hoping the monetary system cures itself while in the meantime, they're keeping confidence high enough to get through the crisis. right? And if they ever decided, you know what, we really need to lower rates to reduce inflation because that'll cut in the U.S., the budget deficit by $1 trillion a year. It's the biggest deficit reduction they could possibly do. And that will cause prices to go down, which would be true, or, to stop going up, be a deflationary bias. Then people would think they're crazy, would lose confidence, and the whole system would collapse. I can't tell you that's what they're thinking, but I'll throw that out as like a remote possibility.
So the next one is by Jarno Letola. I hope I've pronounced that right. Can exchange rates and imported inflation become a problem for a monetarily sovereign government that depends on, for example, food and energy imports and isn't a major exporter of, for example, oil or natural gas?
So that comes down to what are called your real terms of trade. And so any nation has, imports and exports in pretty good size. And the difference is the trade deficit or the trade surplus. And if you look at these food importers, and these people are always referring to emerging market countries, African countries, correct? That type of thing. They don't look so much at Japan, right? Who's importing all their resources. And I believe it was a food importer last I checked. So they're looking more at these emerging market countries.
I thought he might be referring to the UK, but maybe I'm wrong. Yeah,
maybe the UK. And so the UK has a fairly large trade deficit, right?
Yeah.
Last I checked. Okay. So that means the UK is importing more than it's exporting at current prices. And so the UK is benefiting to that extent, right? Its real terms of trade are what they are. They're favorable because when it's running a trade deficit, it's got favorable terms of trade. The rest of the world is sending more to the UK than the UK is exporting. So worst case, those would get equal because you can always use export revenues to buy imports. Anybody can do that. The problem is when you want to get more imports than you have export revenues, and the UK's managed to do that for a long time. So the UK's managed to stay, ahead of that game for a long time. What can happen, though, is your real terms of trade can change. So whatever the UK is exporting, it might need to export more to get the same amount of food, for example, or it might need to export more to get the same amount of energy. And that's what's happened. Okay, so energy in real terms has gotten more expensive. And I'll just focus on the energy things just to make the point here. And so that means when your real terms of trade deteriorate, where you need to export more, Range Rovers to get the same amount of, natural gas, you have to work more labor hours to produce exports that bring in the same amount of gas because there's a foreign monopolist setting price or for whatever reason, scarcity, whether real or contrived. Then your real standard of living drops and so real terms of trade are critical. And yes, if you're cut off from that, then your real terms of trade can drop. Now, if you don't import gas and somehow want to produce your own, that's going to take a certain amount of labor and other things. And that might be even worse than the labor that it takes. That might require more labor than the labor it currently takes, even at the high prices, to produce the exports to get your gas. So if it takes, 1,000 hours of labor to get a certain amount of natural gas today, and that labor is going into exporting of something, financial services, I don't know, and you decide to produce your own natural gas, but it takes 2,000 hours of labor to produce that. Now you're even worse off. Okay, and that's what productivity is all about. And those are public decisions that, governments should be looking at and considering when determining, what makes sense and what doesn't make sense for an economy to do. And they're not. They're not even beginning to look at those types of things. They're just letting your real terms of trade, flap around in the wind. And your standard of living is just going up and down all over the place. And they're not making rational decisions to do that based on, real terms of trade and standard of living. So you'll see some countries decide, they want to grow their own food. Well, that's fine, but it takes so many more people to grow the food, they're actually worse off. And that's kind of happening in the U.S. We've decided we want to do our own manufacturing. Well, now we have far more manufacturing jobs, but that means fewer other things. And that shows up as manufactured products being more expensive. And our real terms of trade are worse off for having done it. And that's what the tariffs have done to us. That's what tariffs do to everybody. So it's a little bit complicated. I've got chapter 5 on trade goes into it a little bit in my 7 Deadly Innocent Fraud books, and maybe enough to answer the question.
This is from John Ibbotson. Max on the UNFTR podcast argues that it's not OPEC keeping the oil price high, but quote unquote Wall Street. He says there's no oil supply shortage. Demand elasticity is close to zero, below about $110 per barrel. The oil price is set on NYMEX and ICE, if I'm saying that right. They bid it up immediately following the pandemic and keep it high because it suits their books. The market participants are mainly oil majors and mega banks. What do you think of this theory?
So as a point of logic, I entirely disagree. When you have a market with a fixed demand, and I agree with that, and available supply right now, so let's say the fixed demand now is 100 million barrels a day, and the available supply might be 101 million barrels a day or something like that. You don't have a market in the normal sense of the market where. And what I'm saying is if all the suppliers decided to compete to get their whole 101 million sold, they could drive their price down to zero and, or very low before somebody is forced to cut production. And in a very short run, that might not happen. And we've seen that type of thing happen on the futures market where the price went negative. And so markets don't work when you've got a fixed demand and when there's a supply and excess of demand. But think of a restaurant that has 100 people coming to dinner, and they all want fresh fish, and the restaurant has 102 fish. And if it tries to sell fish at the market price and has an auction for those 102, the price will go down and down and down until they're getting nothing for their fish, okay? They have to restrict supply and say, look, I'm only going to sell 100 and it's 50 pounds per dinner or whatever. Otherwise, it's not going to work. On the other hand, the opposite happens. If they only have 98 fish or 99 fish and there's 100 people at this Wall Street restaurant who want to buy fish, and the restaurant says, okay, it's going to the highest bidder, and they're short one fish, it could go up to anything, right? That's kind of what the oil market's like. When there's an excess, it would go to zero if some supplier was not restricting supply in real terms. And it would go to infinity or until demand is reduced, cut, if there's an actual shortage. And that supplier who's restricting has to have, as the evidence that there is a supplier doing that is there's a supplier with, material excess capacity. And the only supplier with the material excess capacity is Saudi Arabia right now. And they work with Kuwait, but it's basically Saudi Arabia. And it's Saudi Aramco. And they also, don't forget, trade for their own account, which is perfectly legal. And they have a huge prop desk, which makes huge profits, trading for their own account. They're the marginal supplier. They're the price setter. It's good work if you can get it, as they say. And so somewhere in this mechanism, they have to be the one somehow setting price and letting quantity adjust. And that's exactly what they're doing. You have to look closely at it. You have to have information I don't have to know precisely what's going into their decisions. But what they set are called the official selling prices, and they are spreads to benchmarks. So their spread to Europe might be $2 over Brent or something like that. And there's a fair value between Saudi crude and Brent crude based on the sulfur content, and I don't know what that is, but they know what it is. And if they set it above that fair value, maybe the fair value is $1 premium because it's got less sulfur or something. They set it at $2 over, they put a dynamic in place that causes them to be the highest price seller because they've set it higher than fair value. But the market has to come to them at the end of each day or shut the lights off or change their inventory. But basically, that doesn't happen. I agree with his assumption that demand stays fixed, which would include inventory changes. And they set an upward dynamic to prices by doing that. Or if they set it at a slight discount, they set it even with Brent when it's worth $1 more, then they set in the opposite dynamic and the price goes down until they change policy. And that fair value is changing all the time as refining margins change. So it's a moving target, and every month they reset their OSPs based on their calculations of where things are going, based on what they want to see in the market. Do they want to see prices going up, going down, or staying as unchanged as possible? And they watch it. They don't have exact numbers either. So they're watching the dynamics, and then when they change their OSPs, they're deciding whether to put a little more upward pressure or a little more lower pressure. And just because they lowered their OSPs doesn't mean they're putting less upward pressure. It could mean refining margins have come in and they're maintaining the same spread to fair value, which is not publicized, right? That's something you'd have to calculate. And as a point of logic, there's no other way this thing can happen. And they will be in control of prices doing that until the demand exceeds the supply, if the demand goes to 102 and the supply is only 101, then they can't do that. They have no control and it just goes up. Or if the demand drops enough where they're not selling any at their posted prices and then the price just collapses because their oil is no longer needed at the end of each day. And that's my story and I'm sticking to it.
Next question is a great question by Shane Doubts, who asks, my possibly mistaken understanding is that the vast majority of money circulating in the economy is created by commercial banks when given loans of various kinds and overdrafts. Is this accurate? If yes, does it follow that government policy regarding regulation, guidance, etc. of the banking sector is much more important than fiscal policy?
Right. Well, when you say much more important, that could be anything, right? But yes, you could consider it part of fiscal policy in a sense. The banks are all members of the, Fed member banks. Taxes are paid by having reserve accounts debited. Anybody who's not a member has to have a correspondent bank relation with these banks. And lending is entirely controlled by the Federal Reserve Act and the regulators established by the Federal Reserve Act and the terms of lending established by the federal government through its regulators. And that policy is determined with an eye to exactly what you're saying. Is bank lending expanding to the point where it's a problem? We need to change policies on bank lending. If it's we want to influence bank lending to be more expansionary, like they did after 2008, 2009, because they wanted more of that kind of expansion, then we have to adjust accordingly. Now, the interesting thing is the way they adjust largely is by changing interest rates, which you now know is backwards and doesn't work as intended and has adverse consequences. The more informed way to alter bank lending would be through other direct tools of lending, such as don't accept financial assets as collateral. That would be a good start to stop all this financial speculation. And they can do that by decree very easily. Then there's absolutely nothing that I can see that serves public purpose in the current rules, which permit accepting financial assets as collateral. And that's just one example. So I guess the answer to the question is I agree with you. And to clarify, it is an active part of government policy, much like fiscal policy.
And we'll link to your proposals for the banking sector, which I think come from maybe 2010. We'll link to that in the show notes as well, because again, it's not an overly long set of recommendations. It's about 6 or 10 recommendations, which are very easy to read through. So we'll link to that. Related to that, this question is from Cag Lee. The way I understand it, a bank creates money when it makes a loan, so long as it has sufficient reserves required by regulations. If it lacks sufficient reserves, it has to borrow excess reserves from other banks in order to be compliant. If there are insufficient reserves in the entire system, then the Fed adds reserves to the banking system through the sale of treasuries. The commercial banks now have enough reserves to comply with the regulations. The loans are made and the money is added to the money supply. Ultimately, the money is created by the Fed, added to the economy through the commercial banks to cover the loans originating at those banks. Why not say a commercial bank acts as a conduit through which the government creates money, adding to the money supply? Even though it seems to be a matter of semantics, describing normal banks as a creator of money, I think adds confusion to the understanding of where money comes from, at least for me.
Let me just correct part of the question. The Fed would buy securities to add reserves, not sell them, but that's just a typo or something. So the way I say it is the banks are agents of the Federal Reserve. However, it's not reserve requirements that constrain lending. Banks make loans that create deposits, because when a bank makes a loan, they're buying your signed note, and they pay for that note by crediting your account. So that is a new deposit that wasn't there before. So it's a purchase, and purchase of a financial asset. Lending is a purchase of a financial asset. So it's all about government spending, right? And they're the agent of the government. And then 2 weeks later, because there's a lag, they look at their deposit balance. You look at what your deposit balance was 2 weeks ago when you calculate your reserve requirement. If you're deficient, it's history. There's nothing you can do about it. So the loan's already been made. The bank's already bought your note. They've already paid for it. The, quote, bank deposit, which we call money supply casually, but it's a bank deposit, has already been created. And it's determined there were no reserves. And so not having reserves did not constrain that process. What the Fed does then is they say, okay, you have a negative balance in your reserve account. Okay, because you made a loan and your reserve requirement's $10 million and you don't have it, your reserve account is now negative 10 million. It's like if you have an overdraft account at your bank and you write a check and there's no money in your account, they say, okay, you have an overdraft loan of, in this case, 10 million. Now, an overdraft is a loan from the Fed. Okay, so that overdraft was created at the time the bank made the loan. By the bank doing it, by not having any money in a reserve account, it results in an overdraft as a matter of accounting. So the loan created the deposit and the overdraft, which is the loan from the Fed. So it already happened. It's not, the Fed doesn't say, oh, you're overdrawn, so we're going to lend you money. The overdraft is a loan. The bank now goes out and says, okay, I don't want an overdraft loan from the Fed because there's a penalty rate. So now I'm going to go borrow it from somebody else. And they try and do that to clear out the overdraft from the loan from the Fed. I've been saying, it's in my proposals you outlined, just leave the overdraft loan from the Fed. It doesn't make any difference whatsoever. It allows the Fed to control the system better. It's more efficient. You don't have to hire guys to buy and sell Fed funds from each other for millions of dollars a year and burn up all that electricity and overheat the world for nothing. It's just a huge inefficiency built into the system, arguably left over from the gold standard, but in any case, certainly nothing you would ever do today, clean sheet of paper.
John Lowe asks, recently Jon Stewart had Johns Hopkins economist Steve Hanke on his show, who quoted a study that said the increase in the money supply creates inflation for every nation studied. Some countries like Japan are not seeing much of an increase in money supply, and therefore inflation is lower. Therefore, US inflation is caused by the government creating too much money. Bank loans were included in the money supply. In fact, they were the largest factor. Would you agree?
Well, let me just interrupt and say there is no Fed study or central bank study anywhere that agrees with that. But go ahead.
Right. So bank loans were included in the money supply. In fact, they were the largest factor. Would you agree? If you were debating him, what would be your reply?
I would say that the causation, to me, is clear, and to any Fed researcher who studied it, is that the inflation causes the money supply to grow. Inflation causes a shortage in the money supply. If you're go shopping and you normally go with $200 in your pocket and suddenly prices double, now you need to have $400 in your pocket. If you're Apple Computer with $250 billion in cash and prices double on everything, your operating expenses double, now you need $500 billion in cash. It's been clear in all the studies I've ever seen, the real studies, that inflation causes a money supply shortage, which can also cause other severe problems, and that the money supply that's the charts associate with inflation it's the inflation that creates the need for the money. The inflation leads. The inflation happens first, and then money supply catches up. And that's been the Zimbabwe, the German Weimar. It's all the same thing. So I completely disagree with them. I've talked to Steve before, a few years ago. He's in favor of these currency board things to control money supply. And I pointed out that if you have a currency board like that, you have to have net exports to fund your own financial assets. And that costs your economy 5% of GDP every year, year in and year out in real terms. And your standard of living is reduced on a compounding basis 5 full percentages every year. He goes, well, yeah, you're probably right, he says, but I think it's worth it. So I don't want to talk to him anymore after that.
This is from Thomas Clarkson. Wouldn't a job guarantee at $15 an hour plus benefits raise the cost of entry-level labor for all firms paying less than that? Oxfam says 32% of US workers earn less than $15.
Okay, so the answer is yes.
Good. And wouldn't some of that additional firm cost be passed on to consumers?
The answer is yes.
However, after that, the federal government would control the price of entry-level labor by setting the job guarantee wage, so no more increases unless the federal government wanted them, right?
Right.
Plus, the job guarantee, especially with free childcare as a benefit, would likely increase the supply of work-ready people, right?
Right.
That was it.
I'd also want to add that I think it would be hard-pressed to make the case that it would raise the cost of living for everybody by more than, 0.1%, and probably less than that. But it also increases the total real wealth. It would also increase incomes for everybody else because that money gets spent. And, the reset would be 0.1% higher in the CPI for a year, and then it level off after there. And the real wealth would go up by more than that because of the useful output created as these people transition out of the job guarantee into the private sector. And none of those people argue that the private sector jobs don't add to real wealth. And so the whole point of the transition job, the job guarantee, is to promote the transition from unemployment, where they're not adding anything, to the private sector. And the idea is that if the public sector needs more employment, it should just hire them at the normal public sector wage scale, not the job guarantee wage. Job guarantee is only for people the government doesn't want and therefore doesn't hire at the normal, wage scale. And therefore, these people are intended to transition to the private sector. And they will. And the number of them in the transition job will be minimal, if the policy is maintained properly.
So the next question is by Davey, and it says, how can the euro be saved? And in brackets, and by saved, I mean from the forces of plutocracy and generational debt peonage, such that elected leaders can have access to the means to spend on subsidies the people want and tax behaviors that are deemed to be socially excessive. Alternatively, is the euro worth saving?
So are they asking how can it be saved politically or operationally? If it's politically, that's like interesting question. Operationally, it's easy. But politically, I don't know the answer to that, except it's gone a long way. So back when I started this, and the euro was just came along, that was one of the things that got MMT going, got me thinking in these lines. And we had our 1996 conference on the euro, and we talked about the things that had to change and that were going to change. It's just a question of how long and when. And one of them was that do what it takes to prevent default by Mario Draghi. That had to happen to keep the banking system from bringing down the whole system. He had to do that, or somebody had to do that. Somebody would be faced with that decision and would make it in that way. And I wrote a paper called Rites of Passage in 2001, which is on my website. And it's all outlined in like one page. So you can see the whole process, and what the forecast was in 2001 and how it all happened. And the other thing that has to happen and will happen is that the 3% limit would become moot, and the deficit needs to be a policy tool rather than some kind of fiscal limit. And with COVID, you saw how the deficit became a policy tool. They wanted 11%. They went to 11. Now they want 5 or 3 or 0, but they're using it now as a policy tool. And the idea that there's a 3% limit is kind of out the window. So that was important. So now they know they have to guarantee all the member nation debt, and it works. And they've done that, so there is no more risk of default. And now they understand that they can use the deficit limit as a policy tool to get the outcomes they want. Now, how they use it, when they use it, that's the process they're going through now. So they're there. And just simply using that as a policy tool in I'll call, for me, would be a progressive constructive manner, will get the outcomes that they want. And the euro area will be the most prosperous area in the world. And so they're close. They've got through the hard part. They're now just deciding how to use this new policy tool, the fiscal limits. I think certainly won't take more than another 30 years to get there.
That doesn't sound long.
Yeah, no, I don't know how long it'll take. It might take less than that, maybe tomorrow. But they're on the right path, but they tend to take a long time on these things. And maybe because they get paid so much to discuss it, they're charging 500 euro, staying at €1,000 a night hotels while they discuss it. They don't have a lot of incentive to get it done anytime soon.
Results-based wages.
Yeah.
Okay, this is a follow-up from Paul Dandurand. He asks, I understand now from Dirk Ehnts that each EU country has its own central bank, and that's where money is created in the EU, not at the ECB. I'll just dive in and say that's not quite what Dirk said.
No, those central banks are they're just branches of the European Central Bank, functionally. They're Euro institutions. So
yeah, I think but Dirk said, when you talk about the currency issues in the EU, you want to talk about the ECB and the Eurosystem. I think that's how he put it. But anyway, Paul goes on to ask, however, the European Parliament and the Council, managed by member states, define country fiscal spending limits and also whether or not the ECB will jump in to buy bonds if needed. Remember Greece?
Right.
I guess since the pandemic, these limits have been relaxed. The question is, what's next? Does each country have more power than their citizens believe?
The power is still at the central level. They're going to find the Commission and central bank. They're going to be deciding how much leeway every country has right now. And so there can't be individual country decisions, just like the U.S. states can't decide how much deficit spending each one can do. It has to come from the federal government. Otherwise, you get a big race to the bottom where whoever deficit spends the most wins, or whoever doesn't gets left out. You just have a hyperinflationary situation. So it has to be controlled from the top down.
I think what Dirk was saying is because the ECB have kind of had a bit of another whatever it takes moment and pledged to buy up any debt from any Eurozone member nation.
Yeah, that's different from being able to spend additional money. That's just controlling the rates on the debt.
But it's more a case of like if they end up having to issue bonds to do more deficit spending, and the ECB have said, yes, we're going to buy infinity of euro debt.
Well, it's just what I just said. If the Federal Reserve said they'll buy all the state bonds, then they can deficit spend all they want. You just have hyperinflation.
Well, I think that's kind of what's happened in the Eurozone since they've taken the debt brake off. But I guess what Paul's asking is, in that context, then the individual Eurozone member nation banks do have a little bit more power than they did a few years ago to deficit spend to the moon. And
well, they're not allowed to do that by the Commission.
Oh, okay. There is a rule in place.
Yeah, they control that. And what they'll say is, if you start doing that, if you violate the rules, then we'll pull away this umbrella of solvency, and then your spreads widen out, and you're going to go insolvent. So they use that for their compliance, for the whip, to keep them inside the rules, to keep them in bounds.
So the next question is by Paul Dandurand. What's your guess as to why we have not seen top quality investigative journalists do deep dives into MMT to see what it's about, which could expose the lies about the deficit? There must be a few out there that are not puppets of neoliberal media owners. Why are they not pushing back on the lies about how money works?
Yeah, I think it's just personal. They don't want to give me the satisfaction while I'm alive. Let's go on to the next question.
Okay. All right.
Okay.
This is the last one. This is from John Ibbotson. Was Jesus an MMT economist? Show me the coin used for the tax. And then they brought him a denarius. Then he said to them, whose head is this and whose title? They answered, Caesar's. And then he said to them, give therefore to Caesar the things that are Caesar's, etc., etc.
Yes. So I think that
we win.
I think up until 200 years ago, everybody understood it. It was obvious that the movie theater has to sell the ticket first before it can collect it. This used to be obvious, and somehow it's gotten all turned around.
Excellent.
Okay. MMT in the Bible.
Jesus, the MMT.
Yeah. Well, it was called tribute money back then. It was called tribute money for a long time. They demand taxes be paid, tribute money be paid in the king's coin when you lost a war, and you had to export to get it. So sure, that was the way it operated. Everybody knew that. It was no mystery.
I think that's a great place to leave it. We've been speaking with MMT founder Warren Mosler, and we'll link to where you can stay current with Warren in the show notes for this episode, and also to some of the other things that we spoke about in the episode. But for now, thanks so much for joining us today on the MMT podcast, Warren Mosler.
Thank you all. Much appreciated.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month, and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.